Since late 2023, one of the world's biggest investors has bought more than 4,500 British homes, spending around 1.4 billion in the process. And this isn't a one-off. Institutional money is flooding into the rental market at a pace we've never seen before. So why are global finance giants suddenly chasing the same properties as everyday landlords? Our team spends their days talking to the people behind these deals, developers, builders, and pension funds. So we know the inside story. And in this video, we'll break down what's causing this massive shift, what it means for smaller landlords, and whether there's anything you can do to protect your investment. You've probably seen the headlines. Blackstone, one of the biggest investment firms in the world, is buying up British homes at speed. In just the last 2 years, they spent around £1.4 billion on deals involving 4,500 properties. And that takes their total UK portfolio to more than 17,000 homes so far. Now, this isn't the first time big institutions have invested in housing. Pension funds, insurers, private equity firms, they've been doing this for years. But we're starting to see a shift. Because up until a few years ago, they were only investing in luxury apartment blocks and student villages. What's changed is that they've turned their attention to family homes, the kind of properties that most people associate with small landlords. And the numbers show the speed of this shift. According to Savills, 54% of all institutional investment in 2024 went into single-family homes. That's up from 32% the previous year and just 5% in 2019. So in just a few years, institutional money has completely shifted its focus from shiny city centre flats, often aimed at young professionals, to the same streets that ordinary landlords have been buying on for decades. And that's what's catching everyone's attention. Because if the world's biggest property investors are suddenly competing in the same space as everyday landlords, what does that mean for the rest of us? And are we about to be pushed out completely? Well, before we get into that, let's talk about why they're doing this. Because the world of buy-to-let is more than a little uncertain right now. Landlords are selling up, regulations are tightening, and mortgage rates have spiked. We keep reading that small investors are trying to get out. So why would a company like Blackstone be throwing billions in? Well, for a business like Blackstone, this isn't about flipping houses or chasing short-term gains. They want to build something steady, something that pays them every month, year after year. They want predictable inflation-linked income, and residential property delivers exactly that. When markets wobble, people still need somewhere to live. And the pandemic was a huge factor in changing how institutional investors think about risk and reward. Because previously, they'd always been allergic to the idea of owning a lot of individual homes. Much easier for them to own one shopping centre or office block with only one tenant to worry about than 1,000 family houses. But during COVID, retail and offices took a beating while residential property just kept going. Even as offices shut and people shifted to shopping online, rents boomed, and a surprisingly small number of people even fell behind on their payments. And that consistency is gold to investors managing billions. Even so, they don't want houses dotted all over the country. That's why they started with whole blocks of apartments, and now they're buying entire new housing developments. Everything's under one management system, yet they can still spread their risk across hundreds of homes instead of one giant asset. So when you look at it that way, it makes sense. They're shifting towards a safer, more diversified, and more resilient income stream. While, because of their size, they're better able to cope with all the new regulations than individual landlords are. And in fact, it's going so well for these big investors that a lot of smaller landlords are understandably starting to panic. If the institutions have the money, the scale, and the tax advantages, doesn't that make the rest of us redundant? Quickly, before you panic about keeping up with billion-pound investors, make sure that you've nailed the basics that are in your control. Things like running the numbers properly, choosing the right tax setup, and knowing where the best opportunities are. We've put together a free expert investment toolkit to help you with all of that. It's packed with the exact tools that we use ourselves to analyze deals and avoid expensive mistakes. Click the link in the description to download it for free. All right, now let's look at what this really means for landlords. So before you start phoning estate agents and getting your properties valued, let's work out how bad this actually is. Because I won't lie to you, you might have to make some changes to the way you work. But should you give up completely? Well, not necessarily, because in some parts of the world, this has been happening for quite some time, with institutional investors snapping up brand new developments and offering high quality accommodation to hundreds of tenants at once. In Germany, for example, big companies own around 37% of all rental homes. And rental markets like in Germany haven't collapsed. In fact, they're some of the most stable in the world, where tenants have choice and individual investors are happily coexisting with the bigger players. Now compare that to the UK, where big investors currently own just 3% of rental homes. So maybe it's not a complete disaster after all. But as that proportion grows, it is going to change things. Because when big companies enter a market, standards often go up. Because these properties are newer, managers will have systems and processes to make everything efficient and professional, and there might even be an in-house maintenance team ready to fix issues within a couple of hours. And let's be honest, many individual landlords don't operate anywhere near those standards, especially those who've been coasting by with dated properties and slow response times. So if tenants start ditching those properties in favour of the ones owned by big corporations, can you really blame them? Because when renters have more choice, the power balance starts to shift. We've seen this before when the big players entered the student housing market, and the landlords who'd been lazily renting out tired house shares with one bathroom between 6 bedrooms found themselves forced out. There is good news though, because if you're a landlord who keeps your properties in good repair, responds to issues quickly, and generally just gets on well with your tenants, you shouldn't have anything to worry about. Think of it this way. If given a choice between a mouldy house owned by a disorganised and unreliable small landlord, or a clean and modern family home owned by a huge corporation, of course, tenants are going to choose the latter. But while I don't have any data on this, I'm pretty convinced that given a choice between a good small landlord and a good big landlord, most tenants would choose the former. People tend to like a personal touch, so if the price is virtually the same in either case, it could work in your favour. Especially as institutions are going to be far more aggressive about putting through annual rent increases, which, even if tenants aren't aware of to start with, it will become known. But you will need to make sure you're offering a professional service and treating this like a business, because the days of being an accidental landlord are numbered. If you want to keep attracting good tenants, you'll need to think and act more like those professional investors. That means staying on top of maintenance, investing in properties that are easier to manage in the first place, and building systems that make your life and your tenants' lives simpler. That's what companies like Blackstone are doing, just on a much larger scale. They're treating renting as a long-term business, not a side hustle. But you don't need billions in funding to take the same approach. You just need to be intentional by buying quality homes, looking after them properly, and focusing on providing a service. If you can do that, you'll not only survive these changes, you'll probably benefit from them, because as weaker landlords exit the market, competition will thin out, and the ones who remain will be the ones that tenants actually want to rent from. So hopefully I've reassured you that your days as a landlord aren't numbered, because if you're running things properly, there's still plenty of room for you in this market. But here's the thing, even the best landlords can get squeezed out if they're not managing their portfolio in the most tax-efficient way. Because while the big investors have whole teams of accountants structuring everything with precision, most individual landlords are still paying more tax than they need to. So before you think about expanding or even selling up, make sure you've got that part right. And watch this video next, where I sit down with an accountant to find out how to pay 0% property tax completely legally.